Hello and good morning, everyone. Welcome to Almus Market Mornings, your daily dose of financial updates with me, Swaraj. Today, I have with me our money market pundit, Pankaj Rathi, and we will be discussing the latest developments in the world of financial markets. We continue to have a volatile session in the currency market with dollar index cooling off. And yesterday, Indian equities had a bad day backed by the sell-off in global equities. Pankaj, good morning. What developments are brewing in the markets? Take us through them, please.
Uh, Good morning, everyone. And now we are into basically a volatile period. Markets are going through one day up, one day down, some kind of a consolidation sentiment. But global market continue to struggle with BSP holding a firm grip. Although there was no fresh macro negatives, we are seeing a derating of many stocks which had been inflated due to easy liquidity and low rates, but now impacted in a tightening scenario. Large US retail giants have seen their stock slumps as consumption is expected to moderate with higher cost of living and Fed looking to curb demand. On the other hand, manufacturers are still grappling with the hit to production and supply chain issues remain. We are seeing some sign of China opening up. Probably this will cool down. Without signs of inflation and supply chain easing, we are unlikely to revert to a bullish trend. The debate in the world's largest economy has now shifted from extent of interest rate hikes to the timing and extent of an imminent recession. This has led to softening of US Treasury yield, basically yield curve entirely. 10-year yield touched a low of 2.77% before reverting to the current level of 2.85%. And the yield curve is also flattening to the spread of 22 basis between 10-year and 2-year. With stocks unlikely to perform well and signs of slowdown in economy leading some to believe that Fed hikes may not go too far from currently discounted. That's why we are seeing some buying in treasuries. Economic data in coming days will need to be watched, and more soft numbers could lead to an inversion of a yield curve, which will be an early indicator of a recession. The current challenge for central banks is to control inflation and at the same time avert a stagflation scenario. Dollar seems to be slowly delinking itself from risk sentiment. A sharp sell-off in equities failed to take the dollar index much higher yesterday, made a high of 104.64 versus a previous peak of 105.01, indicating that the greenback is overbought. There was a good amount of a retracement happened. There was a strong buying of a Swiss franc by the market after the Swiss National Bank officer indicated possible rate rise to fight inflation, indicates a possible readjustment of a dollar value. We expect a retracement in euro towards 1.0650 and GBP towards 1.2650. Sense of topping in yield supported a rally in gold yesterday. The yellow metal is seen well supported at 100 days DMA around 1793, and yesterday I think it went as high as 1845.46, currently dealing around 1840. Despite the ongoing risk of sentiment and overnight rally in the dollar index, USD INR failed to break the 77.80 levels yesterday as well, where the central bank had strongly intervened earlier in the week. Their constant presence dissuaded players from taking long position at these levels, and buying was purely led by genuine requirement while traders stayed away. As we got minutes of the last meeting day before, now market is fully convinced that there will be another rate hike on 8th June, which will be between 25 to 50 basis. Near-term rupee is expected to move in a narrow band and unlikely to match the bigger swings in dollar index due to domestic fundamentals. We believe that today's range would be in the range of 77.30, 77.60. For medium-term direction, oil holds the key. That's all from me. Thank you.
Okay, that was crisp, Pankaj. And as Pankaj mentioned, stocks are slumping with consumption moderating. There is inflationary pressure in the market. So volatile session continues. As we say, we need to manage our risk very, very prudently. Till then, have a very good weekend. We'll see you all next week. Thank you.